Hi, welcome everyone to another session of our Global Employability Expert Series. You know, this is a webinar we offer to our internship participants so they can keep on learning and developing very interesting and useful skills for work life and beyond. So let's explore the title of today's session. So we have this very interesting topic brought by Abhinov Balagoni, and the title of the webinar is Discover the Graduate's Guide to Personal Finance. Before we jump into today's topic, let's remember how the webinar works. So basically, we are recording this session so you can rewatch it later on. You can share it with other people you think may find this interesting. And then you can, if you skipped a part, you can also watch it entirely. So remember, you can always subscribe to our YouTube channel where you will find our previous webinars. And every time we have a new webinar coming up, then you will be able to see it. So you can subscribe if you haven't done so. Remember, we have the Q&A section box here that's a place where you can ask any questions you have for a speaker. So please be free to write these questions and we will cover them by the end of the session. So please share your questions. If you have any doubt about your program, you know, the specifics or of your virtual internship, please reach out to your IEM. The IEM is a person you have been emailing with throughout your program experience. So let's jump and see what's the topic for today, right? What we're going to discuss in this webinar. So managing money is a skill you need throughout your entire life. Mastering it becomes really important once you start your professional path. Being intentional about planning for your financial future is thus essential. In this webinar, you will learn useful tips on how to approach this new phase of your adult life. And I'm very excited, therefore, to introduce you to our speaker, Abhinov. And so let me tell you a little bit about Abhinov. So Abhinov is the founder and CEO of Pax Credit, a Techstars company that eases the financial needs of international students. Previously, Abhinov was part of the Entrepreneur First cohort in Singapore and completed his education at the Singapore Management University and the National Institute of Technology, Warangal. So without further ado, thank you for being here and welcome, Abhinov.
Happy to join, Meta. So what I'll do is I'll just quickly go through a few slides just to give how do we approach the personal finance part, and then probably post that we could take Q&A. I'll start by sharing my screen. Allow me a minute.
Yeah, perfect. Thank you.
So I'm Abhinav. So as Mita has introduced me, I'm the founder and CEO of Pax Credit. So even before that, I was a recent graduate. And because the company is a financial technology company, I was grappling with this personal finances products and stuff like that. And I've actually understood how the different products are structured from a financial institution's perspective, as well as a recent graduate, what are the needs and things we would like to have as well. So our agenda for today's webinar is we'll briefly talk about 4 topics, starting with how do we budget our monthly income and expenses. Post that, we'll also look at how do we manage our debt? How do we pay off the debt? In what order? Are there any ways to minimize the debt? And then followed by what exactly is a part of credit score and how can we actually take care of it? Because that becomes an important part as we go forward. And what are the key things you could do to optimize your savings and investments? So these are the 4 topics we'll touch upon. So the first one is how do we budget our monthly income? So there's this rule called something like 60-30-10 rule, or it could be a different variation of it. So what it essentially means is that a majority of your income would be spent on the essential items like rent, utility bills, student loans, majority of the cases, commute or car leases, these kind of things. Then you put aside 30% of the income for the non-essential things like either shopping, dining out with your friends or family, and then travel. And then you put aside 10% of the income on the first day itself towards an emergency fund or for investments. This is how you split your income. I mean, this could be a variation like 60, 25, 15 if you want to increase the savings component, or if you want to reduce the savings component and increase the essential or non-essential part, you could do it. But this is how briefly you can split the income and budget the expenses. Now, the second part is, in most cases, students would have some kind of a debt, predominantly student loans, or if they were to probably commute to their work, even a car loan as well. In this case, in most of the lenders do have the option of auto pay. So when you opt for an auto pay, the monthly installment gets auto debited from your bank account, and because there's a reduced risk, the lenders tend to give a discount on interest for about 0.25% of it. Not many lenders do, but there are majority of lenders that are actually coming up with this option. So that way you can reduce the interest rate burden. The other way you could minimize your debt is looking for a refinancing option. What does refinancing mean? If you have an existing, say, student loan or a car loan, there would be another lenders who would be interested to give same loan based on the same thing. It's effectively balance transfer of your existing loan at a much better interest rate. That way you could reduce the interest component and the installment amount as well. And if even that option is not available, then the third one, effectively to reduce the debt, different kinds of debt, what you could do is you could try and optimize paying off the debt with the highest interest rate. So if you have credit card debt and a student loan debt, usually credit card debt tends to have a higher interest rate. So it's better you actually pay off the credit card debt first, maximize for it, and then followed by paying off the student loan. That is how you would manage your debt. Post that, how do you go about building your credit score? This is because you're all new graduates, your length of history of credit score is minimal. But as you go forward, when you try to buy a house for yourself, a car, or any other such things, credit score becomes an important part of that transaction. So there are 4 to 5 things that are key attributes for your credit score, starting with your payment history. So your historical payment history for your existing credit loans or credit accounts is what contributes. The other one is what is the kind of amount or the utilization you have across those credit cards or loan amounts is also considered while calculating your credit score. And the other one is length of your credit history, which in your case would be minimal, but as you actually progress along, that would be taken care of by itself. And the other one is the new credits, as in what are you applying frequently for new set of credits, either personal loans or credit cards, that also kind of reduces your credit score. So these are a few things you would have to keep in mind while managing your credit score. And the final thing, which we have talked about in the first slide, how do you manage your savings and investments? I mean, most people are probably not well aware of the options out there. So even as a beginner, you could do the basics right, and that would save you a lot of money and time going forward. So in most cases, your employer would have some kind of a retirement plan. 401k is a common thing in the US, but in general, anywhere in the world, that's what is made available, and retirement or an investment plan. So try and maximize that option. Whatever is the contribution you could do to that specific account, maximize it. Followed by that, since we talked about having a savings account on the emergency fund, what you could do is you could park these funds in a specific account which gives you a higher interest rate. So most of the banks have separate account like savings rate or high interest rate accounts, and even digital banks also have these facilities. So you could park your emergency fund in these accounts, and you could get almost 2x or 3x of the interest rate, which is what a typical bank would provide on your checking account or a traditional account. And if you're a newbie and a beginner and you want to try out how stock investing works or investments works, what I would suggest is you could start with index funds or ETFs or exchange traded funds. What it means is effectively a basket of most popular or most largest company stocks or part of it. So get exposure to a wealth, a breadth of company stocks rather than just getting exposure to a specific company stock. stock. So that is how you get exposure to the stock investments or investment market as well. So these are the few tips you could actually do it. And I think you would actually see the difference in your personal finance just 12 months from now if you actually get these basics right. And if you are keen, you can actually double down on how do you make maximum use of your investments or your debt and things like that. But I think if you get these basics right, you're far ahead than your peers, is what I would say. Happy to answer any questions you have.
Well, thank you. So I was thinking, right? You mentioned like the number one rule is like to have this split our income, right? This 60, 30, 10%. Do you have any concrete tips on how we can do to start doing this? Because I know when we start, we can kind of think this is the way we should do it, but do you know, I don't know, any apps or any concrete tips that we can have to implement these?
Sure. I think the first one is the day you receive your salary, you need to have it auto pay to your savings account. So if you have a checking account and if you receive your salary, the 10% of it should be auto transferred to your savings account or your emergency fund, the way you park your funds. So that way you wouldn't have access to those funds, so you wouldn't spend it at all. So that is one way to do it. Then regarding there are multiple trackers, spending trackers, or even banking apps these days come up with your spend history. So that way you can keep them separated as in pockets wise. But I think that's number one thing you could do. Have a digital account for your savings app, transfer it on the day you receive your salary so that you wouldn't spend that. You would have access only to 90% of it. And in most cases, the rent, utilities, and student loans and commute is something you cannot actually manage. You could manage it, but effectively they get deducted from your bank account. So you're only left with the non-essential component or the income in your bank account. And that's up to you. How do you plan to spend it? So the 60% is taken care by itself. And 10% if you actually auto debit or auto transfer on the first day, you're left with the non-essential income. That's about it.
Yeah, definitely. Thank you. And so when we mention, okay, savings, right? And you said, yeah, do you have any recommendation for daily days, for apps for daily day budgeting? Like daily day, that's the same. I mean, everyday budgeting.
So daily budgeting, I mean, the ones I could think of is there is one called Mint. There's another one called Splitwise. These are two of the apps. But frankly speaking, I haven't actually explored the digital apps as such because, I mean, these are the apps I have tried almost 5-6 years ago. Probably there are a new set of apps that probably help you with this. But I think, yeah, there'll be plenty of budgeting apps that would help you for this use case.
Splitwise, I think that's the one that you can split costs where something
Friends,
you need to pay with another person, right?
That's right.
I've used
friends.
that. That's super helpful because when we go out with friends, for instance, right? And usually, I don't know, there's someone who pays for everything because I don't know, I have my credit card and then it becomes a little bit uncomfortable to ask for the money to someone else. And then if you have this app, then you can say, hey, you have in your app how much you need to give me back. And that's a good way to track also money we may spend that we hadn't foreseen, right? So we have here a very interesting question. What do you think is the best way to manage hidden costs in your daily life?
Now, that depends on your daily lifestyle is what I would say. But one thing you could look at is whenever you're trying to sign up with any recurring transaction or any recurring payment service, just think about it if there is an alternative available. That's the only thing I would suggest. Because what happens is, even if it's a small amount, because it's recurring on an annual basis, it turns to be a huge cost factor, and bunch of them put together is a significant expense. So that's one thing I would actually ask anyone to look up. Just think before they actually pay for it. Otherwise, most of the things are very personal in nature, is what I think.
I see. And so you mentioned, okay, we need to leave this 10%, right? Ideally, so for our savings. And you mentioned we have different options for saving. What kind of options do you recommend? Like, I know there are different type of accounts, right? We can have like accounts where we leave money for a certain amount of time, or we can just have an account that gives no interest. What is your suggestion of that? How we should understand? Yeah.
In most cases, there are usually these dedicated bank accounts where there are high interest paid on it. They call it savings account, they call it money market accounts. There are different names to it. but in different markets, they are named differently, but the use case is the same. If you park funds with them, the interest rate paid on those accounts, bank accounts, is usually 3 times or 5 times higher than what the usual regular bank account would be, like checking accounts would be. So you need to make use of these accounts provided by the same banks itself. Bank itself would have 2 set of accounts in most cases. This is usually the terms used are US specific, but this applies across different markets is what I would say. So even digital bank accounts, in most cases, I believe in most markets, there are digital banks right now, and they tend to offer these services as well. So along with your traditional banks, you can look at digital banks, which have these savings accounts options, which offer high interest rates.
Yeah, and so what is a good interest rate, or what should I expect? For instance, I know it depends on the bank or where I'm in, but
So
more or less.
So I would say any savings account which pays you almost like 3x or 4x of what your traditional bank would pay, I think that would be a good interest rate. So say I would take the example of Singapore bank account. So in general, depending on your income, salary, or payment utility bills, the interest rate on your regular account or say salaried account varies from 0.05% to 0.5%. But in some cases, you could have up to 1% as well, depending on the few terms that needs to be fulfilled, high interest rate accounts. So that is what you can look at, because it is 2x of what the traditional bank would provide. You could opt for those accounts, high interest rate savings account. They would term it as fixed deposits as well. Sometimes they would term it as savings account, but that is the usual difference. It's almost definitely more than 2x is what I would say.
I see. And is there some kind of, when we think about having these savings and having this money for things things we haven't foreseen, do you think is there like a kind of a minimum we should have? Like, sometimes there are these rules, like we should have an amount of X salaries saved.
Yes. So that's right. So emergency fund, I would say usually that should cover your expenses for 6 to 9 months, bare minimum, ideally 12 months, but at least 6 to 9 months is what you could target.
Yeah, I imagine we need to be a little bit prepared, right? And so when we think about, you mentioned digital banks, right? Do you have like, I don't know if these kind of banks work that everyone can now open accounts depending on where you are. Is it like hard for someone who does not a job or has a not super paying job to open an account? How does it work?
I think, yes. I mean, there are different sets of users and banks have different sets of accounts as well. So they do have these kind of accounts with no minimum balance or no zero account fees. I think you could opt for those kind of bank accounts since you're just starting off. That's the kind of account you could use for. And later on, when you have probably a sufficient balance, probably could opt for the next set of accounts or the next version of it. But I think you could start with the zero balance accounts or no minimum balance accounts. And that's how you can get started. And digital banking apps tend to offer these services. So that's why I suggested them. But I think there are a few cases where even traditional bank accounts also share this.
And can you recommend any of these options online? Where can we find these? Or
so I think
Google for it?
For US specific, I could suggest Discover is one good bank which has an online savings account. And there is, I believe, there are a bunch of them, Marcus by Goldman. But I think Discover in most cases would actually be sufficient for most people.
Excellent. I see.
And just a plug, towards the end of the year, we would have Pax Credit's own bank account in the US. So we would offer markets leading savings rate. So if there is a user or their friends in the US, by the end of this year, they would be able to create a bank account with Pax Credit. And we offer market leading savings rate of close to 3%.
Yeah, and I wanted to know more about Pax Credit. Can you tell us a little bit about what you do and how you came up with the idea?
Sure, certainly. So what we're building at Pax Credit is a financial app to ease the needs of international students. So there are two specific needs we are trying to solve for. The first one is cross-border payments. The other one is access to affordable credit. And the first one is that we help students, international students, pay their university tuition fees or in general educational expenses using our cross-border payment solution. in their local currency, and in the process save about $500 to $1,200 when compared to local banks. This is the savings, and the funds transfer gets completed in minutes instead of days. This is what we do. The other one which we're trying to come up with is the bank account and a credit card product for the incoming international students or existing international students in the US to start with. So they would be able to create a bank account months before they even land in the US. They can pay to their landlords to secure their rentals. And based on their banking history with us, they would get access to a credit card as well, where they can pay back any transaction on the credit card in installment payment plans, which is almost 50% lower than what the traditional credit card providers would charge. So that is what we are building. So solving for payments and access to credit, this is what we are building at Pax Credit.
Yeah, that's super interesting and useful because, well, I don't know, I'm no expert in finance or whatsoever, but I am always surprised how expensive it is to send money internationally, right? Like sometimes when we want to send, I don't know, 100 US or 100 euro to a company, a business in Europe, me being in Argentina, maybe I will have a flat cost of 50 euros, right? Which is half of the money I'm sending. And I'm like,
that's right.
This is so expensive.
And that's
so yeah.
precisely the problem you're trying to solve. Predominantly in the emerging markets, when someone is trying to send money from these emerging markets to the other side of the world, they tend to pay high costs, either in terms of transfer fees or exchange rate markups. And we are trying to actually bring that down.
Yeah, definitely. And so we were talking about saving, right? And this 10% and how we should prepare for our future. Would you recommend a student to get an insurance plan with a saving attached? I mean, I understand that they are really cheap when you are young and it can help with the long-term saving and cover risk of unemployment, but this is not something we really think of when we're young, right?
I would suggest anyone could probably get started with the life insurance plan. I mean, health insurance is usually provided by the employer. So if that's available, probably you can have an add-on, or if that's helpful or that is very comprehensive in coverage, that's good enough. But I think we can have a life insurance plan regardless of age. As long as you're earning, I think it's a good practice to have a life insurance plan.
Yeah, because I think there are different options, right? Where we save every month a little bit. And then if we stay, I don't know, 5 years, 10 years, 15 years, and we can claim our money and kind of have more, no, that doesn't work like that?
It does work like that, but I'm not usually sold on that idea. So what I go for is a pure life insurance plan on an annual basis. So if something happens to the one who's actually earning, the family should not get affected. And that's what is taken care by life insurance plans. So the plan which you suggested usually has some kind of savings and investments put together in the insurance plans. And I do not actually believe it. Insurance is meant to minimize risk. It is not meant to maximize your wealth. Investments are meant to do that. So I kind of separate both of them, and I use the insurance plans purely in terms of managing risk.
Perfect. Yeah. And so, well, paying debt, we were mentioning, right? One second very important aspect of paying debt. I know many students in the US, especially, right, to go to university, they need to take these huge, costly debts, and that's quite of an issue. And I was surprised because so we can refinance a debt by asking more debt. That's how did I understand correctly, or how does it work?
Let's say you have, say, 30K US dollars as your student loan, which you have taken probably for your education. Now you might have gotten that loan somewhere around, say, 10% interest rate, assuming that's the case, or 8%, whatever might be that. Probably you could look around and shop around if there is another lender willing to offer same loan, existing loan account with a much better interest rate. That's what refinancing means. So if you have an existing loan account of an outstanding balance of 30,000 US dollars, and if they are willing to actually transfer that loan account from other lender to their own lending institution at a much better interest rates, that's what I meant refinancing. So you tend to pay lower interest rates or lower installment amounts for the same loan because you got a better deal.
Okay. I see. Um, well, this is for me coming from Argentina. This is something that we don't understand for paying university, because we have the state pays for higher education. We do have private universities, but the scheme of going to the bank and asking for a loan to pay university, that doesn't really exist in our country. I definitely understand, because I have many friends from different part of the world, and I know how it works. But for us, it's kind of interesting, and I know it's kind of really hard, because when you leave university, you have already all this amount of money to pay. So you really hope that your next job will give you at least as much as you need to pay for your debt. So yeah, I think this is really useful to have these tips and strategies in mind. And so you also mentioned about this very interesting topic about building credit score, right? So if I understood correctly, like this means that perhaps it can be like more beneficial to my own credit story to actually had to have already had some credit or some debt, and that looks good, instead of like having a totally polished credit history.
Yes, I think it's like a chicken and egg problem. You need to have a good credit score to get loans at lower or affordable interest rates. And in order for you to actually get good credit score, you need to have a credit history or credit loans already. So because most of the audience are new graduates, they would have the length of credit history or credit accounts would be very minimal in general. However, what they could do is probably they could just create a new credit card or a secured credit card and just pay it on a monthly basis, just so that the payment history is much more, the credit history and the payment history is more in number. So the credit score tends to become much higher. And gradually, whenever they require a mortgage or a car loan or any other loan, they would usually get better interest rates just because they would have a better credit score. That's about it.
Okay, thanks for clarifying this. Yeah, I've never liked asking for credit. I always have my bank calling me and offering me things I've never asked, and I'm like, oh, do I have all that money available? And I'm like, yeah, and then I'm like, no, thank you, but because I'm very conservative with money. So yeah, it's good to know how we should do it. And so yeah, savings and investments, right? Because you said, okay, we can save. It is good to save, so we have a fund prepared in anything, something arises, something we haven't foreseen, but we can also save to invest money, right? And so what are the kind of investments and young graduate could foresee today? If I don't understand anything about investment, where should I look for? Yeah.
I mean, you can certainly look for personal finance blogs online. You can read about it and you will certainly gather information. But even if you have no clue, there are two things anyone can do, and that sets the basics right. One is, in most cases, people tend to have some kind of a retirement plan or retirement account through their employers. So you could maximize the monthly contribution to that account. That's step number one. Usually there is a case of employer matching that contribution. So that way, if you maximize your contribution, you'd get, would you recommend investing crypto? Actually, I'll answer that. So you could do that. The second one is stock investments. Most people might not necessarily be comfortable identifying the company stocks to invest in. So what they could do in broader, just to have exposure to the economy in general, they could actually put the money in index funds or exchange traded funds. So what these are essentially is a group of company stocks put together, and that's how they are traded on the stock market. So when you purchase a unit of these funds, ETFs, what you're getting essentially is an exposure to this bunch of company stocks, which are usually most strong in financials. So that's part of it is already taken care by market. So there are a couple of funds people can actually look at. One fund is called S&P 500. These are like the largest 500 companies to get exposure to them. Then there is another one. If you're interested in tech companies, there is a NASDAQ 100 or NASDAQ 550. The top tech companies are usually listed there. And that's how you get exposure to those. So I think if you actually get exposure to these two kind of funds, you're good enough to get started with, is what I would say. And I just saw a message or chat option that someone asked, do you suggest investing in crypto? I mean, I believe you could probably put aside a small portion of your savings into crypto, and the two blue chip projects or cryptocurrencies, you could say. Bitcoin is one, the other one would be Ether, because there are already existing institutional investors, including large banks, that have already invested or facilitating these tradings into these two projects. I would say it's probably okay to invest in those two projects. Other projects, depending on your risk profile, it's up to you.
And yeah, when you say invest in these projects, like I've seen that lately, the cryptocurrency market has been going really down, right? So I'm struggling to see how we can invest in that, because I've seen, like, I know some people that have some Bitcoins, and they have been some Bitcoins like 0.0001 Bitcoin, right? Because one Bitcoin is a lot of money. And they have been selling them, because that's how does it work? How can we really make money and invest in cryptocurrencies?
I mean, how I approach this is similar to how I would approach investing in a company's stocks, right? If you believe that in the long term, in the next 3 to 5 years, the company would actually increase their revenue potential, the market potential is out there, they would be users for the company products and services. That is how you generate more income or revenue from a company's perspective. In crypto case, what we would say is we will probably see the adoption of those crypto projects. So if there are different applications being built on Bitcoin network, there'll be a requirement for Bitcoin network in general, or on Ether as well. So wider the adoption of a potential crypto project, the more might be the value associated with it, economic value associated with it. And since we have a small unit of that network, and that's how the investment value could grow over the years. That is the assumption here. And since we do not know how the market potential or the utilization of those crypto networks would be, it's still not at matured investment, is what people, and that's why people tend to stay away from it. But yes, there are a few real world applications, and these two projects do have few real world applications. So that could be, yeah, that's how I would view it.
Okay, yeah. So maybe this is something that I can buy when it's very low and wait until, like, in the next 3, 4,
Yes.
Many years, price goes up, and there's the return. I see.
I think they're interesting questions. Well, let me do that. Okay,
Yeah.
I'll read the questions and then try to answer them. Is it common
Yes.
for startups to offer entry-level employees to invest in company stocks? So in general, most of the startups, at least the ones which are backed by venture capitals, venture-backed startups, they tend to offer a part of compensation in company stocks. I mean, that could be even for entry-level employees. It varies depending on a startup, but in most cases, they do offer it. So when the company raises a subsequent financing rounds, venture financing rounds, the company stock value gets assigned a significantly higher value in the next 1 or 2, 3 years down the line. So that is how the employees also get benefited if the company grows further. So I would say that is how it would work. Would you recommend investing in crypto? Answer that question. Would you recommend a student to get an insurance plan? Okay, that's a, I think, yes.
Yeah.
Yeah.
Do you have any more questions? I think this has been super interesting. So if we have any more questions for Abhinov, let's just ask them. So yeah, so for me, I think that it is very useful to start thinking and planning ahead, just like you mentioned, because most of us, we just start our work life, and then we kind of, well, our audience is quite young. I'm a little bit older than them, but for me, like the last 10 years of my life have gone by really, really quickly. Like when I realized I was already 30 and I was like, oh my God, how did this happen? Right? Time goes super, super quickly. So it is good to have this idea, and the powerful idea you're bringing us today is that let's start reflecting on this. So because, and especially because during all these years, like we just said, right? Maybe we can buy some piece of Bitcoin or something and then just leave it there. And in a couple of years, we have some return. And there are many things we can plan ahead by the time we are a little bit older. We have our finances already a little bit more stable, right?
Right.
So is there any piece of advice you would like to share before we wrap up, Abhinav?
I think there's one book recommendation I would like to share. There's
Excellent. That was like our next question.
Right.
So
Sure.
amazing.
So I think one is there's this book called The Psychology of Money. I think if people have time, they should probably read about it just to have an understanding as to how money works or how things can be managed. I think that just gives you an overview as to how you could manage your personal finances. I think that more or less actually covers the basics, and people will be pretty sorted by the end of the book, is what I would say.
Excellent. So the psychology of money, recommendation from Abhinav to all of us. I'll take a look at that. And so, well, Abhinav, thank you so much for having been here with us today. So for our audience, if you want to connect with Abhinav, you can find him through LinkedIn. Here we have his information. And I do think this is a very interesting and important topic. So well, maybe we can all explore this book you just suggested. And remember for our participants that you have 2 coaching calls in a program. So if you want to reflect on your next professional steps, where your career is going, where would you like it to be going, then take advantage of these 2 coaching calls because they are included in your program. And remember, you can subscribe to our YouTube channel and see our previous webinars. So thank you very much, Abhinav, for having joined us. It was really interesting having you, and thank you everyone else also for having been here today. So I wish you all a super excellent day.
Bye, Meta.
Bye, everyone.